Welcome to How Do They Afford That, the podcast that peeks into the financial lives of everyday Australians. I'm Michael Thompson. I'm a writer and the co-host of the Fear and Greed Business Podcast. And as always, I'm with Canna Campbell, financial planner, founder of Sugar Mama TV, which is, of course, a financial literacy platform that you will find on books and Instagram and YouTube and podcasts and everywhere. Canna, hello.
Hello. Michael, I've got a question.
Ooh, go on.
We've been recording now, I think we're up to something 23 podcasts-ish. And we met with you not really knowing much and being very skeptical about money and...
It's my default position
maybe.
is skepticism on most things. Yes.
Well, it keeps you safe.
Yeah.
How have you found your relationship with money?
Wow.
That's like...
Oh, that is a broad question to kick us off today.
I know. Well, how do you feel about money? How do you feel about your financial future after launching this podcast together?
Okay, look, no, that is a really good question. Good.
Okay, good.
Good. No, I can give you a little bit more than that. No, I've learned a lot through this, and I think it kind of goes right back to when we were beginning, and it is just about changing the way you think about money. And I always thought I had a fairly good kind of grip on how money worked, but also how my own money was organized. And doing this podcast made me realize that that good grip was in fact a very, very loose grip, and that there are better ways to operate, that really there are simpler ways to operate in terms of budgeting can be done a lot more simply, that there are a lot of ways out there to save money that you just don't necessarily think about, and that thinking about it is probably the key to it. You actually just need to be mindful of it and kind of look for those opportunities both to save some money but also to make more money. So look, I think my relationship with money has definitely evolved over the last kind of 22, 23. Gosh, we should check these things before we start, shouldn't we? I think we're up to episode 22, 23. But yeah, it's definitely has kind of improved. I'm excited about today's episode because it gets into something. And last week we were talking about manifesting, which is a very intangible kind of concept that can lead, as we discussed, to some quite tangible things. But today is very much one for the investors and one for kind of people who want to know how to make their money work harder for them, potentially without having to do too much hard work themselves, which sounds like the dream, really, doesn't it? But does that answer your question? I feel like I just kind of rambled in the hope that at some point you would forget that you'd asked me a question and I would just kind of move on with the rest of the show.
Take your answer and run with it.
Yeah.
I will ask you another question at the end of this podcast then.
Oh, that
But it's in relation to what we're going to be talking about, which is wealth accumulation through investing.
This is a good one. Okay, so before we get into that, though, it is very, very important that what we are talking about today, it is always general in nature, never personal, investment, strategic, or product advice. It is for financial education purposes only. That
is correct. We don't know anything about what is going on in your world with your financial situation, your assets, your liabilities, what was important to you, your deadline for these goals and dreams, or even your risk profile. It's so important that whenever you want to look at your financial situation, look to improve it, reach out and speak to a financial planner so they can put together a financial plan for you to help you achieve all of those goals and dreams.
One of our most popular episodes that we did was on the FIRE movement.
Oh, yeah.
Financial independence, retire early. Did I get that right?
Yeah,
yes.
That's right.
Yeah. Which you have some reservations about because it was a lot of the headlines are grabbed by people who kind of save and save and save. And that's all they're doing. They are saving their money and they're just putting it away in the hope that they can retire at 39 or something. And then they are just set with this kind of pot of money that doesn't take into account inflation or other kind of expenses or other issues, tax. Yeah,
cost of living.
Yeah, exactly. And we brought up in that episode other ways that people can think about their money rather than just saving it, because saving is obviously important because you've got to get it
in the first place
In
to
the
them
first
to be able
place.
to invest it. Absolutely.
Indeed. So today is kind of almost a bit of a follow-on from that, and it is about investing that money. It's almost kind of hands-off, set and forget investing. Is it what it sounds like, where you are just setting yourself up initially with an investment and then just watching it grow? And that, I've got my fingers crossed as I'm saying it, because I'm hoping that I've actually summed it up correctly, but also that, yes, your investment is going to grow over time and that it's not going to go the other way.
You're pretty much spot on. A set and forget investment strategy is about making an initial investment, which is typically through the share market, through, say, like a managed fund or an exchange traded fund or a listed investment equity, or even just buying shares in a particular company, and then literally going fishing, like leaving it alone to grow and compound over time, typically with the income being reinvested. And it's a very simple strategy. It's very easy to understand. It's also pretty easy to set up, and it doesn't really involve much time of yours.
Okay, so it is kind of as it sounds, that it is about something that you can hopefully do without too much kind of ongoing work. So is it kind of suited to people who don't have the time or don't have the knowledge necessarily to be in there and actively kind of picking stocks and actively managing their funds, and so working with a financial planner or a financial advisor to set themselves up for the long term? Who's it suited for?
Well, look, there are lots of different people in different walks of life and different financial situations that will use this strategy. And as I said, it's very easy to set up. And the benefit, I think, of why this appeals to so many people is it really does take out the stress of trying to pick the right time to invest in the market or pick the best performing managed fund or stock. It's really, for people also have the benefit of time, they have 10 years where they can literally purchase this investment, sit on it, and not have to touch it. So someone who's ideally investing for 10 years or longer, this is set and forget strategies, not for sort of a short-term quick money.
So they don't necessarily need lots of time to set it up, but they just need time to sit on it once it is set up. And
let compounding interest work its magic for them.
Compound interest. This is, again, I think I've referred to the fact that is one of the take-home messages from year 10 maths, is how compound interest works. And I'm excited to kind of hear how it might work in this kind of situation. So is it something that you kind of keep on investing into, or is it the kind of thing that you kind of build up some savings and then go, all right, I'm going to now invest this and then watch it, or do you keep adding to it?
Great question. So actually, you can do one or the other. So obviously, if you are contributing to that money, particularly over a long period of time,
Yep.
the potential money that you can accumulate in your investment portfolio can be profoundly different, because not only are you contributing, remember, you're also it's compounding interest. So all the dividends you're receiving are being automatically reinvested back for further growth. So you really are giving this set and forget investment portfolio strategy the biggest and best opportunity to work for you. So much so that I actually was playing around on the government's ASIC's Money Smart website.
I love the way that you tried to sex that up a little bit.
Well,
it's still got ASIC in the name, so it's probably not particularly sexy. But anyway.
Well, I was in bed with Tom, and we just finished doing our budgets, and I thought, why not?
Got a bit of time to kill. Let's get on the ASIC calculator, Tom.
And so I ran some numbers. I was like, okay, well, if you invest $10,000 at 7% per annum as a set and forget strategy, so literally invest $10,000, don't add any new money to it, and sit on it. And you sit on it for 40 years. So this is something like a 20-year-old or a 30-year-old could apply if they ever think, well, that could be money I could, tap into when I do want to retire. Now, that would accumulate over time, assuming that the interest is compounding monthly. That would accumulate to $163,000. So that's a pretty cool set and forget strategy.
That's not bad.
Now, you do need to keep in mind tax, obviously, and inflation and the fees. So do keep that in mind. But that's a net return, I'm going to call it, of 7% per annum. But get this. Imagine you only start with $1,000, but you just simply do $100 a week.
Okay, so you got $1,000 to begin with, and then you're adding $100 a week.
Still a set and forget strategy.
Yep.
So you're not having to pick the stocks and time the market. It's just literally like an automatic, regular savings plan, but not going into savings, it's going to investment. So an automatic reinvestment plan, $100 per week. For 40 years, under the exact same conditions, compounded monthly, 40 years, net return of 7% per annum. Guess how much money should be there in that portfolio?
I'm assuming it's going to be more than the 163,000 that the other scenario.
Well, how much more would you think? Like double, triple?
I'm going to say, by the fact that you do seem very excited by this, I'm going to say triple.
Way more.
Oh,
so
okay.
$1.153 million. Are
you serious?
Yes. Isn't that insane?
That is incredible. And considering over that time, that's 40 years. And if you're contributing $100 a week to it, which is not changing during that time.
That's not going. So if you get a pay rise, the promotion, you get to spend all those extra money that you earn and earn, like.
And so you are just contributing $5,000, $5,200 a year to it.
With $1,000 initial starting up.
And that's still then at 7% per annum would be $1.15 million.
I'm so much so that I'm actually going to put this on the Sugar Mama Instagram account as a post, and people can actually see the screenshot. And I have got this from ASIC's Money Smart website. I've used their compounding interest calculator to play around. So I'm getting it direct from the safest source possible.
Is that what you're showing me there now? Because that is incredible.
Yeah. That's why I printed it off to show you.
That is a very, very kind of steep rate of growth.
And this thing is with a set and forget. Yes, it can work, and there are dangers which we should definitely talk about. But when you can combine it with a regular investment plan, it's incredible the magnifying impact of it, which I hope that as everyone's listening to this goes, oh my goodness, investing needs to be a bigger priority in my life because look at what I can potentially build an extra $1.153 million in my life by using something that really doesn't involve much time to manage, much time to set up. And it's actually quite achievable. And the people go, I don't have a spare $1,000 to invest. That's okay. You don't have to start with $1,000. You can start with less. And you don't have $100 per week. That's fine. Start with $20 per week or $10, but slowly and steadily increase it over time when you can through your budget. So really, this is something that everyone can consider as part of many other strategies in their life to take investing seriously.
7%, that's based on an annual 7% interest rate. Is that realistic?
Great question. So whenever I do these, I always get people DMing me going, but where can you find a return of 7%? Obviously, you need to get advice. But if you look at the average return of and this is not me saying go and buy Australian shares or international shares at all, but if you go and look at the long-term historical returns of various asset classes, including Australian shares, you'll look at with the franking credits and the dividends and the returns over the long run, the actual average return is actually, depending on which chart and graph you refer to, it's around about 12%. So I'm actually being fairly conservative here.
Yeah. Okay. I want to talk to you about the dangers, the risks here, because this is investing. So investing, of course, comes with risks.
Absolutely. You need to take this seriously. It's not something you haphazardly go out and go use a dartboard and pick a stock.
Which kind of feels like the approach I've taken in the past. And you know what? It hasn't worked particularly well.
I'm not surprised, but
Well, we will come back in a second and talk about those risks. But I also want to talk about, because I feel like I've been in this position before of going, okay, this sounds great, but how do I take that next step? I've saved my $1,000 or I've saved my $10,000. Really, it's probably closer to the 1,000 than the 10,000. But where do I actually go? Where do I take that to? How do I actually get started physically in it? Because that's always the roadblock, the hurdle that I hit, is actually just implementing the strategy. So I want to ask you about that, but we'll come back in just a second to do it. Kana, we're talking about set and forget investing, and you just shared some pretty remarkable figures.
We could all be $1.1 million richer by the end of this podcast if we apply some of the ideas.
Did you just say we could all be $1.1 million richer by the end of this podcast?
Whoa, okay, sorry, that is misleading. No, we could potentially
Have
be
set
on
ourselves
the
up
way.
for.
Yes.
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 Okay.
Yes. That's sorry.
'Cause
My bad.
that would be the very definition of a get-rich-quick scheme. That's
Which I am not about.
No.
But I am about education.
Okay,
I'm
so
informed.
and really, this is all about kind of the wonders of compound interest.
Exactly.
And that is
Backed with a regular investment plan.
absolutely. And you said that you're going to put this is it a graph or a chart?
I'd say it's a chart.
Yeah, because yes, I think you're probably right. And this is a
Tonight I'll be Googling what is the difference between
a
a chart and a graph.
yeah. So okay, we'll stick with chart then for this, and you'll put that on your Instagram and kind of demonstrate just how quickly or just how kind of dramatic the growth is, and particularly the growth in, say, the final 10 years of the term of the investment, because it is very, very steep. But this is based on, say, having $1,000 up front to go and invest, and then adding $100 to that every week, or in the other scenario, which has a lower final figure, starting with a $10,000 investment. But they both have the common theme of it's set and forget, really, where I've got my money. Where do I go? This is the question that I've always kind of stumbled over. Are you taking it to a broker?
No. Well, you can take it to a stockbroker, absolutely, and they can give you advice as to where they think that your $1,000 should be invested.
Yeah.
The other option is you simply open up online share trading account.
Mm-hmm.
And obviously all the major banks have them. There's also lots of obviously international market players that have online broking accounts as well. There's also micro investing apps as well, where they incorporate rounding up approaches with your bank account. So you can also be contributing that way. So there are lots and lots of different ways of doing this.
But you want to focus on something that is diversified.
Yes. So this is, I guess, this is where we really need to talk about the dangers before anyone jumps on any of these apps and starts opening up online share trading accounts.
Okay, so then let's start with the dangers and then kind of get to the how to, the physical element of it. This is, as we said, an investment, so that it comes with risk. Is there a number one risk?
Look, there are lots of risks, but I'm going to just focus on, I guess, the top four. So number one is obviously you must pay capital gains tax on the income you're earning.
Mm-hmm.
So, for example, if I earn $500 in dividends, even though I'm reinvesting them back in my set and forget strategy, I must declare those $500 worth of dividends in my tax return. Yes, they may come with franking credits, which is a podcast for another day, but you must pay the income tax along the way. So whilst you've got to factor in $100 per week regular investment plan, you also may need to factor into your budget that you may need to pay some additional tax at the end of each financial year.
And just because those dividends are automatically reinvested, it is not free money, as we discussed on a recent episode.
Exactly, where that person DM'd me saying how great dividend reinvestment was. And I was like, no, you do.
It's still taxable. Yep.
The other big thing, and this is probably the biggest danger I see, is diversification. So if someone is looking to use this strategy with one stock in one stock or one company, say they decide to take their $1,000 and buy a supermarket stock, and they add $100 a week, buying parcels of $500 or $1,000, they're going to end up with diversification risk, and that all that money is with that one company in that one industry. Generally speaking, you want a diversified portfolio, so you'd have banks, you'd have telecommunications, you'd have transportation companies. You would spread that risk because obviously different industries and different companies all perform differently. And you also may want to step out of Australian equities. You might, for diversification risk, want to include international investments. So you really do need to listen to your risk profile, which we have a brilliant podcast explaining how to access risk profiles and work them out and find out what your risk profile is and what it means and how to apply it. So you've got to make sure you're paying attention to your portfolio, particularly over a 40-year term period, so that your money is spread in positive alignment to your risk profile. You're investing within your comfort zone. And
this is how we get back to that 7% interest rate, because when you gave the example of the market as a whole over a period of time has had a higher growth rate than that. But if you were to look at individual stocks and if you were to put it all on one, that those stocks, hey, it might actually go up by more than that, or it could just flatline or go backwards.
Exactly. And that's the great thing about diversification. You help those winners help cover the losses, because no one's going to be able to pick a portfolio that's going to be perfect and they're all going to make lots and lots of money. You're going to pick some duds. And that's a great thing about using something like a listed investment company or a managed fund or an exchange traded fund.
I'm very good at picking duds. It is a gift. I will share with you.
That's a language that we discussed in Manifesting March. You're not allowed to say that. You're supposed to say, you don't say, I'm a dud at picking stocks. You say, I'm learning about investing and I'm really enjoying the process.
Well, isn't it positive to say, I am gifted with the ability to pick duds?
Because the brain only hears duds, gifted, and more. So no.
Okay, all right, noted.
So, and this is why someone like yourself, I wouldn't recommend wasting their precious time trying to pick the stocks, and get advice. See a financial planner, see a stockbroker. There's lots of free research. Look at things like listed investment companies and ETFs, because they're already diversified and they can be diversified to match a balanced risk profile even.
And with that then, that kind of gets back to that question of how it physically works. And so say you were using a listed investment company or an ETF, that they are things that you can just add. So say you want to go for your $1,000 up front and then add $100, you're able to do that just by essentially buying an additional $100 of that ETF or that listed investment.
Okay, you're jumping the gun on me here, Michael. We're still stuck on the risks, but yes.
I'm just so keen to find out.
Okay, no. So the minimum shares you can buy is $500. It's the smallest trade. So what I would normally say to people, because obviously the cost of brokerage is save up $1,000, do it in parcels of $1,000, hence the $1,000 project.
Yep.
But you can buy in $500 a lot. So you'd basically be manually going and buying more shares every 5 weeks, technically, with that example.
Okay.
So, yes, I probably could have done $1,000 per month, but I'm just trying to keep it, it's set and forget. It's small, it's simple, but it's effective.
Okay.
So you've got to be obviously very careful of making sure it's diversified and you're adding to it. If you're going to be doing that, you might pick a different company or industry to invest in every parcel of $500. But the other big risk is, and this is something really particularly for retirees or people approaching retirement, is their exit strategy. Their portfolio may be quite high risk as they start to approach retirement. So they may have 90% of their money sitting in this beautiful set and forget investment portfolio, where they're going to start needing some of that to help supplement and fund their retirement. So there is a risk as they get closer and closer to needing that money and exiting. Even someone, say, using that money to buy a house, they need to sort of think about how they slowly and steadily exit out of the market. And also they're going to trigger a capital gains tax bill for themselves in selling.
Gotcha.
So that's another good point. And we almost need to do another podcast on this about long-term investing, where you can build up enough income where you don't actually need to invest.
Yep.
So you don't need to sell. You actually can just live off the income from that $1.15 million investment portfolio. But that's something for another day. So there's the exit strategy risk. You've got to think about capital gains tax, and you also got to think about the short-term timing risk with volatility. And then finally, avoidance risk. So the dangers I see with this is people set these strategies up with great intentions, quite often early in life, and they're like, oh, I'm just going to put that away for a rainy day. And good on them, it works, it's great. But there is a valuable opportunity risk, which I've called avoidance risk, where that money actually over time may have been better off elsewhere. So they may have been better off to look at a debt recycling strategy, or where they looked at selling that portfolio down and putting it onto their home loan and then rebuying that portfolio back with borrowed money. Now, we have a great podcast. So everyone who goes, what's that?
Yep.
Go and listen to that podcast.
I'm going to take a punt. I'm going to say it's about episode 5.
Ooh.
It was quite early.
It's a very popular one.
Yeah.
And the other thing is, someone might say, building up that portfolio, they may have actually been better off putting it into superannuation and using it part of a superannuation strategy with financial advice, of course, because that's obviously potentially more tax efficient.
Okay.
Because remember, super is sexy.
That is another episode. I think that one's episode 6. The question here for me is always about, okay, avoidance risk. I understand that, the risk that you might miss an opportunity because you are taking a set and forget. But the beauty and the attraction of a set and forget is that you can just set and forget it. I would worry that I would be kind of second guessing myself too much of going, oh, should I be doing something else with it? Should I be taking it out, selling it down, looking at debt recycling? And in doing so, you potentially kind of end that magnificent kind of growth trajectory that you were on. And this, I suppose, look at me, I'm not only asking the question, I reckon I'm about to answer it as well.
Well, this is an element of avoidance risk is the risk of not checking your portfolio and being too complacent and going, oh my gosh, I should have sold actually a while ago because that was obviously a bad move. And obviously, Harry, hindsight, never made a bad decision. But the answer to your question, set and forget, is about not fiddling with your portfolio.
Yeah.
Not trying to be a cowboy and like pick the next.
I think Afterpay was the example that we've used previously
exactly.
of one that kind of shot up significantly and probably attracted a lot of first-time investors to the market because they saw these fantastic returns. And I suppose this is where it is so helpful to get professional advice.
Absolutely.
Because this is not so much then about kind of the day-to-day movement within that set and forget investment. It is about, is this set and forget investment still the right one for me?
Yeah, is this strategically the right step for me?
Yep.
And look, a financial planner will look at you and say, actually, you can do that, but let's also do this, this, and this, which is even better. And you're not talking about $1.15 million. You're now talking about $3.35 million. You know,
by the end of the podcast.
But
no, definitely not.
So you do need to, and this is the problem with the set and forget, is you can bury your head in the sand and be ignorant. You do need to check your portfolio, make sure it's diversified, make sure it's working for you, make sure it's working for your time frame, making sure that there's not some other better efficient strategy to be including on top of or in conjunction with. So this is what I talk about the avoidance, just avoiding it and not bothering is a risk in itself, along with the opportunity risk.
Okay, so can anyone do this? Kind of regardless, everyone's situation is different, but this is something that anyone can think about.
You know, my kids actually have a set and forget investment strategy.
So your kids are more advanced investors than I am. This is this is a blow to the confidence.
Look, these are teeny tiny investment portfolios. I think between $3,000. But they do. I mean, when there is money, we add to it when we can. And it's very, especially at the moment with rising interest rates, it has temporarily been parked. But anyone can do this. And I'm sharing this with you because I have a 18-month-year-old and I have a 9-year-old and a 3.5-year-old. So if they can technically be investors, anyone can. So this is how you do it. You basically need to go and open up a share trading account.
Yep.
Or go see a stockbroker who can open up a formal account. The more cost-effective and popular way is to have and faster way is to open up an online share trading account. And most major banks have some sort of online trading facility, but there are thousands of them as well. So you need to do your research and work out which one's right for you. And you look at how much the trades cost, what free services they have, what support systems they have, whether they have an app that works for you, it's easy to use, all those sorts of things. But literally you deposit your $1,000 in your example,
mm-hmm.
and you would go in and literally, say brokerage was, say, $20. You'd put $1,020, and you obviously need to factor that into the cost. And you would literally like shopping online. I say to people, if you can buy shoes online, it's actually easier to buy shares online.
Okay.
And literally you go and buy. And then you get paperwork and you from the share registry with your HIN number, and those are your almost like another account number, and you put your tax file details, your dividend reinvestment. Set and forget works with dividend reinvestment. You want to tick that box if it's available. And that's part of this, the key steps in this strategy.
Yeah. And in that you are considering those ETFs, the exchange traded funds, and the listed investment companies that are looking at like a big section of the market rather than just trying to pick an individual company.
And if you Google Australian listed investment companies, these companies will come up. And you can look at their websites, and a lot of them actually share their top 20 holdings. So you can actually, obviously they don't share the whole entire portfolio because that's their IP, but you can see what sort of companies they have in that portfolio, and you can see how the level of diversification is quite profound. And they decide when we're going to buy supermarket XYZ and when we're going to buy some more banking stock in company ABC.
Because they are professionals.
Yeah, professionals.
Who hopefully know what they're looking at.
And they charge a fee, but it's a very competitive fee when you think of the cost of your time.
Okay. And at all times, professional advice.
Professional advice, as particularly around the strategy, the a financial planner might say, let's include a super strategy, a salary sacrificing strategy that will save you tax. Let's look at a mortgage reduction strategy. There's lots of other things a financial planner can do beyond just setting up an investment strategy.
Okay. So look, it's actually a quite a simple kind of topic, really, in that it is just about making an investment and leaving it alone largely. And that it's kind of suited to basically almost anyone who has the time to just let it do its thing.
Get self-control, really.
Yeah.
Don't try and tamper with it.
Yeah. And that there are multiple kind of models that you can be using, that you can be kind of looking at that lump sum and adding to it, or just a larger lump sum, but and jump onto the ASIC website and use the calculator and kind of do some modeling for yourself and see what you could potentially be doing.
Exactly. And also it's very motivating and inspiring looking at this. I got excited.
Can I tell you, one time I actually did this myself.
I'm about to laugh.
I was trying to calculate what my superannuation would be when I retired, and so I multiplied it all out in the steam of the shower glass.
Mm-hmm.
And so it was the longest shower in the world, because I was there trying to figure out and I got to this fantastic sum at the end. Forgot to write it all down, and of course it just evaporated. But it was very, very motivating to suddenly go, you know what, this kind of the compound interest, the set and forget kind of approach is really quite magnificent. And you play around with those calculators, particularly on the ASIC website, and you can kind of see it for yourself. There are risks associated with it, obviously, lots of tax considerations that you need to be being mindful of, the time as well, the exit strategy, the avoidance risk that you were talking about, diversification is another one. Very, very helpful to get professional advice when you're making these kinds of decisions, but it is just something to consider.
I hope everyone who's listening to this feels really inspired and empowered to go, actually, I could do something like this for myself.
Yeah.
And goes and actually does it.
Yeah. And just and looks at it as an option, because it is pretty exciting. All right. We have covered a lot of ground today. Where can we find you, and where can we find these graphs, the charts, as we've decided?
If we've named these incorrectly, please let us know what the technical term. I'm always open to learning and fixing my errors and ways. So the fastest, best place to get me is Instagram at Sugar Mama TV. I will put a grid up there that shows exactly the numbers, what I'm plugging into this ASIC calculator, so you can do exactly the same for yourself and you can see for yourself the results. But I will literally screenshot everything and put it as a grid post so you can really see what we're talking about here. So Sugar Mama TV on Instagram.
And you can hear me every day with Sean Aylmer on Fear and Greed, Australia's most popular business podcast. And hey, if you happen to be in a bookshop or Big W or anything at the moment, you'll also find my book, my novel, How to Be Remembered, which is out now as well. Thank you very much for listening to How Do They Afford That? Remember to hit follow on the podcast, and please leave us a review too. We love those. Next week, we are going to talk about rent investing. Everyone's talking about property at the moment, and rent investing is a fascinating kind of topic, and I'm really looking forward to getting into that one. Don't miss it.